Home sales across Canada rose 2.3% from January to February. Monthly activity, however, is 40% below February 2022 levels. February stats from the Canadian Real Estate Association are out. We'll be talking about which provinces are seeing the biggest year-over-year price declines. I'll also be touching on some insights we got into Canadian mortgage holders following earnings report from some of the big banks. Let's jump into this data together. My name is Roch St-Georges. I'm a real estate broker in Ottawa. I help families and individuals with the purchase, sale, or rental of real estate in our beautiful city. Today we're discussing the broader Canadian real estate market following data that was published by Courtier. So residential sales are still trending down for the broader Canadian market, seeing just over 400,000 sales in Q4. February sales figures are down 40% when compared to February 2022. Looking at this chart, we can see the monthly home sales in red. The black line is showing us the 10-year monthly moving average. So as we can see, we are well below the 10-year monthly moving average and are getting close to sell levels last seen in 2010 and 2012. Our sales levels seem to be picking up slightly, rising 2.3% from January to February. Looking at residential new listings, we are trending down. We had about 780,000 new listings come to market in Q4, down from 820,000 new listings in Q3. New listings are even down month to month, dropping 7.9% from January to February. Low inventory has converted into increased competition among buyers. We've been seeing many stories across Canada of some markets seeing bidding wars and obviously some properties selling over their asking price. In my last video covering the Ottawa real estate market, which you can view right here, we mentioned that we had about 15% of properties in February sell for over their asking price. Now, with the rise in interest rates, many buyers looking to get into the real estate market were hoping for larger price decreases as well as increased inventory levels before jumping in. So why are we not seeing panic sales and increased inventory levels? Well, the answers may lie in the new earnings report we've got from the big banks. We saw Scotiabank during a earnings call discuss some of their mortgage portfolio. We learned that a bulk of their loans, about $91 billion worth, is up for renewal in 2026, as shown in the graph. This means some homeowners may still be a few years away from having to renegotiate or requalify for their mortgage with their lender. Who knows what rates will be at that time and where their property values will stand. At this time, Scotiabank says that the average loan to value, known as LTV ratio, meaning the amount of the mortgage when compared to the appraised value of the property, is at 52% for their uninsured portfolio. I know there's all types of people listening to the channel, so I just want to run through an example to make sure everyone understands. Say you bought a property at $700,000 and you've put a $140,000 down payment, representing 20% of the purchase price. This would mean your LTV would be 80%, meaning 80% of the property is mortgaged up. Back to the Scotiabank portfolio, they say their clients are sitting with mortgages that represent about 50% of their property's value. This tells us that if they choose to sell their property tomorrow, they will be able to pocket about 40% of the equity they had in the property. What could be dangerous, however, is those who bought with 5% down payment, meaning 95% of the home's original purchase price is mortgaged up. Say you bought during the pandemic a $700,000 property, that would represent a mortgage of $665,000. Now, if that property has dropped, say, 20% in value or $140,000, this means the value of your house is now sitting at $560,000, but you still owe $665,000 to the bank, minus whatever you paid off monthly. These folks could be in a tricky situation if their mortgage comes up for renewal. Should we panic? Well, we can already see some big banks allowing clients to amortize their mortgage loans over a longer period of time. So how does this help? Well, let's look at a $300,000 mortgage at 4% interest. So when choosing a 10-year amortization period, your mortgage would be paid faster, but your monthly mortgage payment would be $3,000 a month. Choosing a 15-year mortgage would bring down that payment to $2,250. Now jumping to 25-year, which is often the most popular amortization period, we can see those payments drop to just over $1,500 a month. When looking at the CIBC mortgage portfolio in Q1 of 2022, about 45% of mortgages were amortized between 20 and 25 years. In Q1 2023, this number has dropped to 31%. What is more significant is the fact that mortgages amortized on 35 years or more now represent 27% of their portfolio. We can further see why we may not be seeing an influx of listings on the market and panic selling from these homeowners. For the time being, mortgage holders are finding ways to lower their mortgage payments by amortizing their loans over a longer period of time. If you so far enjoyed the content and found value in this video, be sure to hit the like and subscribe button. If you know of someone that would benefit from seeing this video, be sure to share it with them. Now, the following chart shows the MLS Home Price Index for Canada. So the HPI tracks the average home price for a typical home based on features of homes that have been bought and sold. Based on this benchmark price, we went from a price of $562,900 in March 2020 to a peak in price of $868,300 in March of 2022, which would be at the peak of the market. An increase of $305,000 or 54% in just 24 months. So how does this compare to Ontario's run up in price? We saw the Ontario benchmark price increase $420,000 or 63.5% during that same period. Finally, in Ottawa, the benchmark price has increased $232,700, representing a 50% increase during those 24 months. March 2022 was the peak, but also coincided with the Bank of Canada benchmark rate increases, which saw the real estate market correct downward. We're now seeing smaller and smaller percentage drops in price, which may lead some to believe that we're near a bottom. Year over year, Canada is down 15.8%, Ontario is down 19.3%, and Ottawa is down 13.9%. The chart shows us year over year percentage change for Canada. We know we also saw negative year-over-year price growth in 2009 and in 2018 and 2019. Looking at the MLS HPI benchmark price chart, we know that following the 2009 and the 2018-2019 price corrections, we saw the benchmark price rise rapidly. This large price correction we've been seeing in the last 12 months is leading many to believe that this is a great buying opportunity. Just know that the environment is quite different, both from a financial view and geopolitical view. Now, could prices rally from here? Yeah, they could. Many believe the Bank of Canada will no longer increase rates. However, here's what the Deputy Governor Carolyn Rogers said about the Bank of Canada's stance. If economic developments unfold as we projected and inflation comes down as quickly as forecasted in the January Monetary Policy Report, then we shouldn't need to raise rates further. But if evidence accumulates suggesting inflation may not decline in line with our forecast, we're prepared to do more. Basically telling us that more hikes could be in the cards depending on what data is received. Back to Korea's report, this chart shows the residential average price year over year percentage change per province. We're seeing the largest price correction year over year in Ontario and BC, seeing 20.4% drop in Ontario and a 14.8% drop in BC. As of March, Prince Edward and Newfoundland are still at positive year-over-year price growth. Is Canada in a buyer's or seller's market? We can see in red the sales to new listings ratio, and as we mentioned in a previous video, the general consensus is that when the market is in the 40 to 60% range, the market is said to be balanced. A reading above 60 would mean a seller's market, while a reading below 40 would make the market a buyer's market. We can see that nationwide, the market has been in a seller's market since mid-2019, but has moved back into a balanced market in early 2022 as the market was feeling the cooling effects of rising mortgage rates. In February, we had a sales to new listings ratio of 58.4%, up from 52.6% a month earlier. We will see if we move back into a seller's market in the coming months. We'll certainly keep an eye on this. In Ottawa, we are still in a balanced market as shown in this graph. Looking at inventory levels, we now have 4.1 months of inventory, up from 1.8 months a year earlier. If you're in the market to buy or sell real estate in the coming months, I'd recommend just taking your time. Remember, prices don't go straight up. You don't need to rush a real estate purchase. Also, don't believe everything that is said online, on podcasts, or on the radio, including what I say. I recommend you look at both local stats and trends, but also keep an eye on larger macroeconomic news, whether those are in Canada or elsewhere in the world. The real estate market seems to be picking back up. Just know that there are some news surfacing and indicators telling us that there could be more pain ahead. In Canada, we're now sitting with inflation at 5.9% in January. Data from February will be coming out next week, so we'll keep an eye on this. As we know, they aim to bring this inflation back down to 2 or 3%. So we got a while to go before this is achieved. If we're not making good enough progress, we could see the Bank of Canada step in with further tightening of their credit market. Those also looking at the broader markets and financial news. Last week we had Silicon Valley Bank, a large regional bank in the States, go belly up. This would be the second largest bank failure in US history. Finally, many are looking at the inverted yield curve for the 10-year minus 2-year treasury. This is used by many as a leading indicator of recessions. To put it simply, when we have a reading that dips below 0%, it tends to be followed by a recession shown in gray. We're now at a reading about -1, last seen in the 80s, which brought an economic downturn that lasted for more than a year. Could this time be different? Yeah, maybe. Just be aware of this when making decisions. You may even want to consult with your trusted financial advisor to discuss your and your family's financial position. Folks, you just don't want to FOMO into this market. That's all for me. Thanks for listening. If you like the video and want to be kept informed about the Ottawa real estate market, be sure to hit the like and subscribe button. If you would like to discuss the sell, purchase, or rental of a property in Ottawa, please reach out to me using the information on the screen. Si vous aimeriez discuter d'achat, de vente ou bien de location de propriété ici à Ottawa, mes coordonnées sont à l'écran. Merci beaucoup. Ciao.